All right, we are back. Let's do some of our calls of the day. Jenny, I'm going to start with you. So there was one note from Wells Fargo, which was positive today on industrials and materials, okay, due to AI, which we were just talking about. On the materials note, Rio Tinto today downgraded to hold from buy at Berenberg. They have a more cautious view on China and iron ore, and that leads them to downgrade the stock to a hold. You own the stock. What do you think?
So I think it's a really kind of short-term oriented downgrade. We've owned this since 2017, have a really nice return. What you have is a stock that produces iron ore. And iron ore has held up shockingly well despite the weakness in Chinese construction. And with the stock being down 12% year to date, and by the way, they should have done that 12% ago if they wanted to downgrade it. But with it being down 12%, here's what you're left with. 9 times earnings, 6% dividend yield, 6.5% free cash flow yield. If you believe in the long-term growth of the world, there's enormous, and the modernization of Southeast Asia, there's so much demand, kind of like insatiable, perpetual demand for iron ore. So I say own this for a very long time.
Coca-Cola reiterated overweight. Morgan Stanley, Rob, the price target $70. Quote, high visibility on 2024 top line upside. You own this stock.
God, I know you remember the old Dr. J. Michael Cooper commercial. You can't beat the real thing. You can't beat the feeling. So, listen, this is a stock that's only going to do well as staples start to do better. We trimmed back in March of 23. It's underperformed the index since then by about 14%. Our favorite watch item is equal weight versus discretionary. Equal weight discretionary versus equal weight staples. It's one of the best leading indicators of the consumer. In discretionary is still outpacing staples. So I don't know that this is one that you're going to get any performance from in the very near run. But I thought I'd call your attention to some of those great commercials we used to watch.
I appreciate that, Rob. Thank you. Disney reiterated by UBS. Quote, park segment ready to set sail. Price target, Jimmy, 130. What do you make of this call?
Yeah, I like the call. I'm going to lead with the punchline here, Scott. This is a cheap stock. And the reason I lead with that is because there's been so much drama around the name. I can't even complete the list. There was the proxy fight. There's what are they going to do with ESPN? There's Hulu, et cetera, et cetera. But at the end of the day, on the core element of parks, this has become a cheap stock at 19 times next fiscal year's earnings and 1.7 times book value. And I ask you rhetorically, could you actually recreate this company for anywhere near book value? The answer, it's a rhetorical question. The answer is absolutely not. So, yeah, of course, Parks needs to do well, but I think nobody's giving credit to streaming. Nobody's giving credit to what might come from the Hulu acquisition and what they might do with ESPN. At 19 times forward earnings, I think you want to buy this here.
Jenny, you own it. You agree with that? Would you buy it here? I mean, on the comeback, you would?
Yeah, absolutely. And I think, I almost have nothing to add. It's just cheap. It's trading at $100. I think the 130 is totally fair. Parks are finally getting attention. There's Inside Out 2, which blew away expectations. Cost cutting still in place. I think it's a nice place to be. All
right, what about AT&T? Named a top-rated pick at Citi. They reiterate their buy. Yeah. They prefer large-cap telcos over large-cap cable. They prefer AT&T as their top-ranked pick. Greater number of levers to manage financial performance, as they say. And they like the valuation, which they suggest is cheap.
So I've actually been for a while, I owned both AT&T and Verizon. And I've actually been working out of AT&T and holding the Verizon position. But it's not a negative on AT&T. It's just saying I don't need to own both. If you look at both AT&T and Verizon, they could not possibly be more similar, with the difference being Verizon actually has a more consistent history than AT&T does. But here's what you've got with AT&T. You've got a 6% yield. You've got a 6% yield. You've got 10 times earnings. You've got mid-single digits earnings growth ahead. So if the stock appreciates by the earnings growth, call it 3-4%, plus a 6% dividend yield, you're in the 10% annualized return range. And at 10 times earnings, you have a huge moat of safety there. So I love that. I love Verizon. I love the fact that there's focus on them.
All right. Well, AT&T year to date up 12%. So it's, a trailer of obviously the market a bit, but stock's gotten going
right.
After a period
Finally.
of, yeah, right.